start off, I want to distinguish between joint venture real estate deals and syndication. So we're talking about syndications. A joint venture deal is different, so that's not going to apply to what we're talking about. So the first part of this is the general partnership, or the general partner. So Kirk, you can explain that piece of it.
Yeah, okay, so your general partner is simply this, and there's many different terms that you'll hear for a general partner. They could be called a sponsor, general partner, what else?
Syndicator.
Syndicator. Sometimes you'll hear operator. Anyway, all those terms are synonymous for the general partner. Now that is the person who finds the property, does the due diligence, the research, negotiates the deal, and ends up closing the deal on a property. Then once that property is closed, they're also the group that manages it. And at the end of 5 or so years, whatever the target is, if the market is agreeable, they will divest that property. So that's the general partner. They do all the heavy lifting, all the work. While they're doing that, we're enjoying the benefits of their labor by being passive investors, but they're the soup to nuts operator of any given project. General partner.
So the limited partner puts up the capital for these opportunities that are put together by the general partner. So that could be generally about 90% of the capital required to do one of these deals is provided by limited partners. So the ownership structure is tilted mostly in the favor of the investor. So if you have an 8% preferred rate with a 70-30 split, 70% of that split above that 8% goes to the limited partner. So they're owning about 70 to 80% of the deal itself, all the while enjoying no legal liability, no financial risk beyond their initial investment, and no management responsibility at all. Now, they don't have voting rights, but that's actually beneficial for the general partner in running a business smoothly. Imagine if you had 280 limited partners who could all have a say in a 200-unit apartment investment. That would be a nightmare. So those of us who like passive income and who want to limit our liability and really scale our investing, being a limited partner is terrific. It's a great opportunity.
So how do these two groups work together? It's very, very simple. A general partner may be doing 3, 4, 5 deals a year between closing costs, capital expenditures, etc. Each deal will cost millions of dollars to get into. If you're doing several deals a year, that is an overwhelming amount of capital that is required. So the general partner needs the limited partners to provide capital so that these deals will go through. And that's how the general partner and the limited partner work together in a real estate acquisition.